Iran declared the Strait of Hormuz closed overnight. The U.S. answered with the third round of strikes, hitting something like 140 targets. And there's a missing crew member from an attack on a container ship, and none of that is even the biggest test this week has lined up, because CPI and 5 bank earnings still have to happen before Friday. Good morning. It's Sunday, July 12th. I'm Nick Fertucci with Eleanor Whitfield and Marcus Brooks, and today we've pulled a fourth chair up to the table. Sarah Mitchell's joining us because the biggest story hanging over this week sits right in her lane.
Morning all. I don't usually get the call unless something's on fire, so here I am.
Fair enough. This is the week ahead, which means no play-by-play today. We did that yesterday, graded ourselves while we were at it. Today is about what's actually on the calendar. Hormuz, CPI Tuesday, 5 banks reporting the same Wednesday morning, and whether last week's chip and meta trade has anything left in it. One housekeeping item before we get into any of that, because I got something wrong on air yesterday and I'd rather fix it now than let it turn into a bad call on the books. I said bank earnings land Monday. They don't. Eleanor, correct me properly.
They land Wednesday, July 15th. All 5 the same morning: JPMorgan, Goldman Sachs, Wells Fargo, Citigroup, Bank of America. I checked twice after the show. My Wells Fargo net interest margin call is still very much alive. It's just alive 2 days later than we said it was.
So the season record doesn't actually move today in either direction?
Correct. Nothing to score. We're exactly where Saturday left us. Eleanor, 2-2, streak of -1. Marcus, 2-4, streak of +1. Sarah and Dave both still on the shelf, 0-0, 0-1. Clean board, new week. We start putting real numbers on it. Wednesday. Sarah, walk us through what actually happened overnight, because the headlines move fast, and I want the version that isn't just a scroll of alerts.
Fast and ugly is about right. Sometime Sunday, the IRGC hit a Cyprus-flagged container ship transiting the strait. 1 crew member's reported missing. The vessel was damaged badly enough, the rest of the crew abandoned ship. Iran's response after that was to declare the whole strait closed. The U.S. answered with its third round of strikes this week, something like 140 targets hit overnight.
140? That's not a shot across the bow.
No, it isn't. But I want to be precise about what closed actually means here, because it gets thrown around loosely and it matters for how you trade it. Iran doesn't have the capability to physically seal a strait that's 60-plus miles wide, not indefinitely. What they can do is make transiting it expensive and scary enough that insurers and shipping companies reroute or pay up. Bloomberg had tankers described as trickling through, as of midweek. Not stopped. Trickling.
Which is the same distinction Marcus was making Saturday, that I pushed back on a little at the time. The tape prices, the tradable variable, not the war itself.
This isn't even a new fight, is it? This has been going since February.
Right. The strait's effectively been in and out of shutdown since late February, when this whole thing started. There was a real de-escalation in mid-June. The U.S. and Iran signed a memorandum of understanding on the 18th to end the conflict and reopen the strait properly. That held about 3 weeks before Friday's ceasefire collapse undid it.
3 weeks of calm getting wiped out in a weekend is exactly why I don't love calling any of this, priced in with any confidence. The market had genuinely started believing the June deal would hold.
Right, and the tradable variable here is insurance, not headlines. War risk premiums on Gulf transits were already elevated before this weekend. If they spike again when trading opens, that's the number I'd actually watch, not another CNN alert.
Which is exactly what I said Saturday, so I'll happily take the assist.
You can have it. Brent closed around 76 Friday, up about 5% on the week. WTI's closer to 71. That's already pricing real disruption, not nothing. The open question this week is whether it's pricing enough.
Give me a level, not a vibe. What does enough actually look like?
If we get one confirmed hit on an actual loaded tanker, not a container ship, a crude carrier, I think Brent's through 85 inside a day. Short of that, I'd expect this drifts back down through the week the way it has every other flare-up this year. Because the marginal barrel can still move, it's just more expensive and slower to move it.
And if oil's still sitting elevated when futures open tomorrow night, I'd expect equity futures red out of the gate. That correlation's been tight all week, chips and oil trading off the same headlines, more or less.
And that drift or don't question matters for Tuesday too, doesn't it? Because CPI is going to have an energy component baked in from a very different oil price than whatever's actually sitting there by Wednesday. Hold that thought. That's literally our next topic. Eleanor, take us into Tuesday. What's the setup?
Consensus is a headline print of about 0.23% month-over-month, 2.6% year-over-year. Core, which strips out food and energy, is expected around 0.3% monthly, 3% annual. Some of the previews out there, Kiplinger's among them, are actually flagging a chance the headline number comes in negative month-over-month because energy prices have been falling into the collection window.
Had been. Past tense, doing a lot of work in that sentence after this weekend.
Exactly my point. That forecast was built on an oil price that existed before Sunday. Some of the underlying data was already collected before the escalation, to be fair, so it's not a clean read either way. But if Sarah's right and Brent's still elevated when this actually prints, the inflation is cooling. Story the market wants Tuesday to tell might not be the one it tells.
Plain version. Why does this particular CP1 matter more than a normal CP1 Tuesday?
Because the Fed's own committee is already split. We covered this Thursday. Nearly half of them are on record wanting another hike before year-end, and the Cleveland Fed's inflation nowcast has been running hot, close to 4% year-over-year, well above the official consensus number. If Tuesday's core print lands anywhere near that hot side, the hikers on the committee just got a real data point instead of a hunch.
I'll push back on the doom read a little. The New York Fed's one-year inflation expectation survey is sitting at a 3-year high, sure, but survey expectations have been wrong-footed by the actual prints most of this year. People feel inflation at the pump and the grocery store faster than the data confirms it. I wouldn't pre-position for a hot number just because sentiment's ugly.
I'm not saying pre-position. I'm saying don't be surprised if the negative headline call doesn't happen the way some of the previews are calling it, and don't be surprised if that moves the 10-year more than the equity market wants Tuesday morning.
If Tuesday actually comes in hot, what happens to the tape that same day? Not by Friday. That day?
Historically, a hot core print with the Fed already leaning hawkish is a rates up, growth down day first, and financials relatively okay. I'd expect chips and anything long duration to feel it before banks do.
I'd add, watch whether it's a one-day flinch or the start of an actual multi-day repricing. The market's had a lot of practice shrugging off scary Tuesdays this year, and mostly gotten away with it.
So what do you two actually need to see by Friday to feel good about your read here?
Core at or below that 3% consensus, and the 10-year holding under 460 even if it doesn't. Both of those hold. I think the one more hike chatter cools back down by the weekend.
I need the opposite thing to not happen, basically. I need equities to shrug a slightly hot print the way they shrugged the Fed minutes and the bond auction last week. If a hot CPI actually knocks the market down hard Tuesday, that tells me the shrug we've been watching all month was more fragile than it looked.
Same week, 2 days later, we get the first hard numbers instead of just a data print. Walk me through Wednesday.
JPMorgan, Goldman Sachs, Wells Fargo, Citigroup, Bank of America, all reporting the same morning. That's essentially the entire large-cap banking sector's second quarter results landing inside about 90 minutes of each other.
And your call is specifically Wells Fargo's margin, not the group.
Right, because Wells is the cleanest read on the deposit-to-loan spread story without a big trading desk muddying the number the way JPMorgan's or Goldman's results tend to. If net interest margin's flat or better, that's the yield curve doing what my higher-for-longer thesis says it should be doing for a bank that's basically a pure spread business. If it compresses instead, something in my rate red is wrong, and I'd rather find that out from Wells than argue about it in the abstract.
My skepticism on the banks generally is that good margin doesn't matter much if loan loss provisions are ugly underneath it. Everyone's going to fixate on the spread number Wednesday and might miss it if credit quality is quietly rolling over somewhere in the small business or card book.
I'll jump in for a second. It's adjacent to my beat. Energy and industrial borrowers are exactly the kind of book that gets stressed first if oil stays elevated and rates stay high at the same time. Regional banks with concentrated exposure to smaller drillers or oilfield services names are worth a look Wednesday too, not just the majors.
That's a good add, actually. I was thinking pure rate mechanics, not sector concentration.
It's a small slice of the majors' books, but if you want an early tell on stress, that's where I'd look first.
That's fair, and it's not nothing. Regional bank efficiency ratios have been drifting the wrong way for 2 quarters now. I'm not saying ignore provisions, I'm saying margin's the cleanest single number for the specific question I'm asking, which is whether the curve is still paying banks to exist at all.
And for anyone who wants the 30-second version of why any of this matters, a bank borrows short from depositors and lends long to everyone else. And the gap between those two rates is basically its entire paycheck. Wide gap, banks print money. Curve flattens and squeezes that gap. Banks get squeezed right along with it. Wednesday's the report card on which one we're actually getting.
That's the whole thing, yes. You could have hosted this segment yourself.
I have a producer credit. Let's leave it there. Let's carry the other big thread from last week forward, chips and Meta. Marcus, we called SK Hynix your call of the week Saturday. Does that trade have anything left in it, or did it get its receipt and now it's done?
I don't think it's done. I think it's just getting started, honestly. The DRAM shortage call was never about one IPO popping. It's a multi-quarter supply story. What I want to see this week is Micron actually confirming it in its own stock price, not just SK Hynix's.
I'll take the other side, lightly. Micron's had 4 separate down days across the last 2 weeks on a thesis you keep telling me is intact. At some point, I want the stock to actually agree with the thesis, not just eventually get around to it.
That's fair. It's literally what I admitted about myself. Saturday, right trade, wrong ticker, 4 days running. I just don't think one more red week proves the ticker's permanently broken.
Devil's advocate for a second. What if the market's actually telling you something real by refusing to reward Micron specifically? What if that's not noise?
Then I'm wrong, and I'd rather find that out this week than keep saying intact into next month. That's honestly why I want a checkable level on the board instead of hiding behind the thesis forever.
What about Meta? Does a 15% week like that get a second act, or was Friday the whole story?
I still think the size of the move outran the news. 3 product announcements and a chip manufacturing date don't usually add up to erasing a full year of losses in 5 sessions. I'd want actual developer or advertiser uptake numbers before I'd call that re-rating durable.
Which we won't get this week regardless, so we're both just watching the chart, honestly. I'd rather watch whether Broadcom and the equipment names, Applied Materials, Lam Research, KLA, hold their gains without Meta pulling them along. If the custom silicon trade holds up on its own legs this week, that's a better tell than anything Meta specific.
And if it doesn't hold up on its own, the AI build-out is unstoppable. Narrative gets its first real gut check since this rally started, not just a chip-specific one.
The A and 2 thing, which honestly might be healthy. Nobody's had to answer a real what-if question about this trade in months.
One more calendar item before we leave stocks. Crypto had its own strange week underneath all of this.
Underneath is right. Bitcoin sitting around 64,200, up something like 3% on the week. Total crypto market cap around 2.28 trillion. That's a genuinely calm number given everything else that happened.
Calm, or just not paying attention yet. The fear and greed reading for digital assets moved from 23 to 26. That's still solidly cautious, nowhere near greed. It's grinding higher, not convinced.
Sure, but grinding higher through an actual Middle East escalation and a hawkish Fed is still grinding higher. A year or two ago, that combination knocks 10% off Bitcoin in a weekend, easily.
Or the move's just smaller because there's less leverage in the system left to unwind, not because sentiment's genuinely improved. I wouldn't read resilience into a market this quiet on a weekend with everything else closed. There's just less volume around to move it either way.
So is crypto a read on risk appetite this week, or is it sitting this one out?
I think it's a lagging tell, not a leading one. Equities hold up through CPI and earnings. Crypto probably grinds further into that fear and greed number by Friday. Equities crack. It won't be crypto that tells you first.
Cut that there. Hold the equipment thread. We've still got small caps and the calls to get to. Last topic before we close it out, and it's the one you two never actually settled Saturday. Small caps, breadth, whether the rally under the record highs is healthy or dangerously narrow.
My concern hasn't changed. The Dow finished last week down on the week even after touching a record. Meta and a handful of chip equipment names did almost all the lifting on the S&P side. Narrow leadership under a low VIX is the setup that's bitten people before, and one bad Friday for the Russell against a good year-to-date number doesn't resolve that for me.
Marcus, before you make your case, Steelman, hers for me. What's the strongest version of Eleanor's narrow leadership worry?
Fine. The strongest version is mega cap concentration plus a sub 16 VIX is exactly what every bad correction of the last decade looked like the week before it happened. Nobody rings a bell first. If Meta and 4 chip equipment names are doing all the lifting and the average stock in the index isn't really participating, The index level record is hiding a market that's thinner and more fragile than the headline suggests. And a single ugly catalyst, say a hot CPI print, hits harder than the calm price action implies it would.
That's actually a better version of my case than the one I usually give.
I contain multitudes. I still don't believe it this week, for what it's worth. Capital had been rotating out of mega cap concentration into everything else all year, not just this week. The Russell's up something like 21% year to date, best start since 1991. I think that's the real trend, and the record close narrowness is noise sitting on top of it.
We set a tie break for this Saturday, except I had the date wrong, so let's fix it live. It's not Tuesday, it's Wednesday when the banks actually report. Small cap financials rally alongside the majors on real numbers Wednesday. That's Marcus's healthy rotation case getting real support. Majors hold near records and the small cap banks lag anyway. That's Eleanor's narrow leadership worry aging well.
I can live with the corrected version.
Same. Genuinely don't know which way it breaks.
Good. Don't force it. Quick break before we get to calls. Sarah, first appearance in a while. How was the week away from the fourth chair?
Honestly, on a rig site outside Midland for half of it, so I found out about the container ship the same way everyone else did. On my phone, standing next to an actual pump jack, which felt a little on the nose.
That might be the most on-brand sentence anyone said on the show all year.
I'll allow it. Back to business. Calls for the week. Checkable by Friday, not next session. Sarah, you're a guest, but you don't get to leave without one.
Fine. If the Strait stays open to actual tanker traffic through Friday, even trickling, even expensive, Brent gives most of this move back, and we're looking at low 70s again. If we get one confirmed hit on a loaded crude tanker instead of a container ship, we're talking mid to high 80s before we're talking about anything else this week, CPI included.
Eleanor.
Wells Fargo's net interest margin, Wednesday morning, flat or better. If it prints that way and core CPI Tuesday lands at or under 3%, I think the higher for longer trade in bank stocks holds all the way to Friday. Either one breaks, and I'm rethinking the whole thing out loud next week.
Marcus.
Micron closes back above $1,000 by Friday. If it doesn't, I'm done saying the thesis is intact like it's a magic phrase. I'll actually own that the trade's broken, not just the ticker.
3 calls, 3 different clocks, an oil price, a bank earnings report, a stock level. We'll grade all 3 next week. No exceptions this time. That's the setup heading into a real week. Hormuz and oil, first thing tomorrow. CPI Tuesday, 5 banks. Wednesday morning, and a chip and meta trade that still has to prove it's more than one good week. If the show's useful heading into a week like this one, follow Nova Ventures Daily wherever you get your podcasts and find our full written notes at novaventures.us. Sarah, thanks for pulling up the extra chair.
Anytime there's something worth yelling about,
There will be. That's your Nova Ventures morning brief. Have a good week, and we'll see you tomorrow.